This idea of an inverted yield curve is all over the news. And the million dollar question is, how are interest rate products related to the markets, and how could we use them to give us clues on what to do going forward? This is the Infinity AT charts right now, and what I've done is I've created a overlay chart. Just a line on close chart, really simple. It's a day chart. The white line represents the 30-year U.S. Treasury bonds. The green line represents the 10-year U.S. Treasury notes, and then the blue represents the 5-year U.S. Treasury notes. And these are the higher end of the yield curve. CME also has a 2-year U.S. Treasury note market. It has a federal funds futures market, and that would represent the lower end of the lower duration, I should say, of the yield curve. But we're going to take a look at these three right now, and you can see they move pretty much in sync most of the time. One goes up, the other goes up. The inversion part comes when the actual yield themselves change. As an example, the 2-year yield now is higher than the 10-year yield, which intuitively doesn't make sense, because if you're going to invest money in a 10-year instrument over a longer period of time, you would think there'd be more risk and you'd be rewarded more, and that would be more of a typical type of yield distribution. In this case, it's not the case. It's flipped, and some people are saying, well, this is an argument for a pending recession, whether it's 2 months from now or 18 months from now. There's going to be a recession when this happens. I don't know if that's true or not, or if history will repeat, but what's important to us is to try to figure out how we could use these interest rate markets to trade, or provide us with clues on other markets, because they are related. And so the tip today is going to be, what's the relationship between these interest rate products and, let's say, the E-mini S&P stock index futures. And what I'm going to do is I'm going to add another comparison chart to this. I'm going to simply go over to the left-hand side, and I'm going to hit compare, and I'm going to type in ES, and it will populate the E-mini S&P 500. I'm going to click on that, and it will put yet another relative line. Remember, it's relative, right? So the absolute scale on the right-hand side here isn't going to be shown, because there isn't one. It's just a relative overlay. And here we see in purple the E-mini S&P market. And the thing that stands out to me in general is that there is a bigger inverse relationship when prices are actually trending one way or the other. So you can see that we have a pretty big trend here in the U.S. Treasury bond market, the 30-year, and then we have a pretty big trend here in the E-mini market, and those are correlated inversely pretty well. Alternatively, when things are going sideways, things are going more sideways, then they're less inversely correlated. They're more positively correlated, and you get less clues. So the things I'm looking for is, how strong is the 30-year bond, and if it's very strong, what are the chances that the E-mini S&P on any given minute are going to go ahead and rally and go in correlation with that. And based on my experience, I would say until the interest rate products, particularly the 30-year Treasury bond, starts to either flatten out, go sideways, or maybe depreciate a little bit, it's going to be hard for the equity markets to appreciate. So I'm a little bit leery being bullish as a general matter in these markets. We're going to explore this topic more detail next Wednesday at a webinar devoted to this topic completely. In the meantime, feel free to try a real-time practice account with these charts and with the Infinity AT trading platform. Hope that helps.